Hello and welcome back to Explain the Charts, your go-to channel for detailed market analysis. Today is October 23rd, 2025, and we are diving deep into XAUUSD, or gold, which has just had one of its most volatile weeks of the year. We're going to cover the latest news driving the market and then jump straight into the charts to see what the price action is telling us. First, let's talk about the macroeconomic environment. Gold, as a classic safe haven asset, has been heavily influenced by rising geopolitical and trade tensions, particularly between the US and China. This sentiment helped fuel a parabolic rally that saw gold smash through previous records to set a new all-time high just this Monday, October 20th, above $4,380. However, what goes up must come down, or at least correct. On Tuesday, we saw the biggest single-day price drop for gold since 2020, a massive slide of over 5.5%. Analysts are attributing this sharp reversal to a strengthening US dollar, significant profit-taking after the massive run-up, and some speculation that traders are de-risking ahead of a major economic data release. That brings us to the most important upcoming event, the U.S. Consumer Price Index, or CPI data, set to be released tomorrow, Friday, October 24th. This inflation report is critical because it will heavily influence the Federal Reserve's next move on interest rates, with the market currently pricing in a near-certain rate cut at next week's meeting. Softer inflation would likely confirm that cut and weaken the dollar, which would be bullish for gold. Conversely, a hot inflation number could throw a wrench in the works, strengthen the dollar, and put immense pressure on gold prices. Right now, the market is in a holding pattern, consolidating in a range around 4150 after bouncing from the week's lows. So, with that context, let's pull up the charts and see where we stand. Here on the daily chart, you can see the incredible bullish momentum gold has carried throughout 2025. The price has been in a clear and strong uptrend for months, accelerating significantly since September. This entire move has been driven by those safe haven flows we just discussed. Now, let's zoom in on the action from this month to see that volatility up close. Focusing on these last few candles, the story becomes crystal clear. Here is the explosive move on October 16th, followed by the peak on Monday, October 20th, where we hit that all-time high of 4,381. But look at this massive bearish candle for Tuesday, October 21st. The price plummeted from a high of over 4,370 all the way down to a low of 4,077, an absolutely brutal reversal. The following day, on Wednesday the 22nd, sellers pushed the price even lower, tapping a critical support level right around the 4,003 mark. This $4,000 level is a huge psychological and technical support area. The fact that buyers stepped in here and pushed the price up to close near 4087 is a positive sign, showing that there is demand at these lower levels. This area between 4000 and 4077 is now our key short-term support zone. A definitive break below this would be extremely bearish. Now let's switch to a lower time frame to analyze this breakdown and subsequent consolidation. On the 1-hour chart, we can see the anatomy of the crash and the bounce. Here is the sharp, relentless selling pressure throughout Tuesday the 21st. Notice how the price tried to stabilize, but every small bounce was sold off, which is characteristic of a strong trend reversal. Eventually, the selling exhausted itself down here near the 4,000 level on the 22nd. Since that low, the price action has been choppy and sideways. We can see a clear range forming between the low around 4,003 and resistance around the 4,100 to 4,150 area, where news reports indicate the price is currently trading today on the 23rd. This is the consolidation we spoke about earlier. The market is coiling up and building energy for its next move, which will almost certainly be triggered by tomorrow's CPI data. Switching to the 15-minute chart for the most recent available price action on the 22nd, we can see the indecision even more clearly. The price is making a series of lower highs and higher lows, essentially tightening into a wedge as volatility compresses before the big news event. This is typical behavior before a major catalyst. Traders are hesitant to commit to a strong directional bias until they see the inflation numbers. Now, let's go back to the daily chart to recap and formulate a game plan. Alright, to recap, the market is at a critical juncture. The long-term trend is undeniably bullish, but the short-term momentum has shifted dramatically after this week's severe correction. The key price levels to watch are straightforward. Our primary support zone is between 4000 and 4080. If we lose 4000, the next major support area, or value zone as some analysts call it, is down around 3850. On the upside, immediate resistance sits around 4170 to 4200. A break above this level would signal that the bulls are regaining control and could open the door for a move back towards the all-time high of 4,381. So here are the potential scenarios based on tomorrow's CPI data. A bullish scenario, which I see as a 50% probability, involves a weaker than expected CPI print. This would likely cause the US dollar to fall and gold to break above the 4,200 resistance, targeting 4,300 and beyond. A bearish scenario, with about a 40% probability, would be a hotter than expected CPI number. This could cause a panic sell-off, breaking the 4,000 support level and sending prices down towards that 3,850 target. There is also a 10% chance the data comes in exactly as expected, leading to more choppy, sideways action as the market waits for the Fed meeting itself for confirmation. The most important thing to look for is how the price reacts at the 4,000 support and the 4,200 resistance levels immediately following the news release. That will tell you which side is in control. As always, this is not financial advice. The markets are extremely volatile, especially around major news events, so please do your own research and manage your risk carefully before making any investment decisions. Thanks for watching Explain the Charts, and we'll see you in the next one.